The new year already has started, so it's probably a good time to review all your investments and see if you need to do any adjustments. In today's video, I'm going to share with you how am I reviewing all my investments and what considerations will I take into account in order to improve my asset allocations and my investment decisions. Hello and welcome. My name is Peter B and I welcome you here at My First Million, where we are achieving our financial goals together. I think it's a good idea to review your investment portfolio from time to time. And I usually, when I do a review of my investment portfolio, I usually go through 3 steps, which I just go through periodically, maybe every few months or so, but at least I think it's a good idea to do it once per year. So which are the 3 steps that I'm taking? Step number 1 is I'm taking a look at my asset allocation. Asset allocation means which portion of my investments go into which types of investments. So I mainly invest into real estate, ETFs, individual stocks, and have some positions in cryptocurrencies, as well as I have some cash positions. So these are my main allocation of my assets. So when I'm reviewing my asset portfolio, my investment portfolio, I want to take a look, am I comfortable with the allocation that I put into? And overall, for the asset review, you want to take a look at if you see any risks there and are comfortable still to sleep. Some assets, like for example, cryptocurrencies, can be highly volatile. So if you put too much of your investment portfolio into cryptocurrency, you might go through a lot of emotional changes. Maybe you get very hyped when it's rising, but you also maybe could feel panic if the cryptocurrency markets are collapsing again. So therefore, you want to allocate as much towards each investment class that you feel comfortable with. To me personally, after graduation, I focus especially on buying my first real estate property. So therefore, a big portion of my investment portfolio was in real estate. So since then, I focus more and more going into the stock market and equities, and also build up a smaller position in cryptocurrencies. So therefore, I think for me personally, I will continue probably this path, that I put my additional investments in real estate more or less on hold and try to increase my investment portfolio in the stock market. So at this point, how are you allocating your money into the different investment classes? And do you feel comfortable in the portion of your wealth distributed into these asset classes? If not, number 1, it's probably a good timing to shift some of the money around. Or at least if you have some new savings, put it towards those asset classes that you want to grow more. So then for step number 2, I split my investment portfolios into a passive investment strategy and active investment strategy. And then for taking the passive investment strategy, I just want to understand on a high level if I need to do any adjustments. So on my passive investment strategy, my goal is to invest a specific amount every month over and over again into well-diversified stock market ETFs. So to me, the question here will be, am I comfortable with this approach? Yes or no? Is the amount right? Yes or no? That I put into passive investment strategies. So I'm not really selecting which stock might be outperforming. I just want to have a diverse allocation for this portion and want to profit from the very long-term compounding effect that the stock market is promising, and at least historically has shown us. So currently in my specific situation, I'm investing into 3 different ETFs. So what I will be doing, I will be still reviewing if the allocation is right between the 3. Do I need to add another ETF or do I want to remove one of the ETF? And also see if those 3 ETFs are still the right ones. For example, if you have a very broad, well-diversified ETF, you want to take a look at the expense ratio. And ideally, you have as little expense as possible. So if you pay too much on an ETF, on a very well-diversified ETF, then maybe you can switch it out to a cheaper one. So my second step is reviewing my passive investment strategy and see if I want to take some small adjustments there. Then my third step is I'm taking a look at the active investment portfolio. The active investment portfolio, I would put everything in there where I specifically try to select specific investments. This could be real estate. These also are individual stocks that I'm picking, or even cryptocurrencies. And I want to review if I'm comfortable with all those investments that I have been taken. How am I reviewing this? First of all, I want to take a look at the distribution. How much money is going into each investment opportunity? And do I feel like, do I allocate the right amount of money into the right investment opportunity? So for example, if I have a small stock and a big stock, a big company, a big cap, large cap, am I comfortable to put in the same money, the same amount in both companies? Or do I want to put more in the small one, or do I want to put more in the bigger one? And why my decisions are like this? So this is a thing that I will be reviewing. How much specifically am I putting into each company? And my decisions generally very much depend on a risk-reward evaluation. Risk-reward means the risk side is how much I can potentially lose. For example, for stock market investments, of course, there's always a potential that a stock go bankrupt and therefore the stock goes to zero. But you also want to take the probability into account. How likely is a company to go to zero? Maybe a company that already generates a lot of profits, a lot of cash flow, even have nice cash positions and a low debt level. It's very unlikely that the company will go bankrupt anytime soon, unless maybe its business model gets significantly disrupted. In contrast, a company that doesn't have any profits yet, doesn't have any positive cash flow yet, maybe the revenue is not stable yet, and maybe has a relative high debt level or debt load, this company has a much higher probability to go to zero and go bankrupt. So you want to take this risk, downward risk, into account. But at the same time, you also want to take the upwards potential into account. Some companies might be very stable. They have some upward potential over time, but they might not have a 10x very soon. Like for example, Microsoft or Apple. Will they 10x? Meaning, will they be able to increase the market cap by 10 times, by the factor of 10? Or at least the stock price by the factor of 10, maybe if they're doing some stock buybacks. I highly doubt that. At least maybe it's possible, but not anytime soon, not probably in the next few years already. It will take a long time horizon to make this happen, if it is at all possible. In contrast, a small stock that is growing, that is gaining market share, that is maybe a niche player and has a competitive advantage and therefore has a lot of chance to expand, or is able to turn losses or negative cash flow into profits and positive cash flow, might have a much easier way to increase its market cap by 10 times. So the upward potential is also somehow limited on the company's situation. So in the end, for each specific company, there's a risk benefit evaluation. And for me, myself, I will compare all the positions that I have, and I want to see, do I feel like I put the right amount of money into those companies that have the highest potential? And I want to see that for those companies that I see that have the highest potential, I want to put more in. But at the same time, those companies with the biggest risks, I also want to limit how much I put into, how much allocation I put towards those investment opportunities. So this is step number 3. What are you doing? How are you regularly reviewing your investment portfolio? And especially also, how often are you reviewing your investment portfolio and investment strategies? Please share with us in the comments below. And don't forget to subscribe. Thanks a lot for joining me today. I look forward to seeing you in the next video, and especially I look forward to seeing you winning financially.